Well, good evening. Welcome to this live stream on the 4th of November, 2025. It's Martin North here from Digital Finance Analytics. Great to have you on this evening. Thank you for taking some of your time out, and nice to have you there in the chat and also watching the show tonight. As always, we're going to have a really interesting conversation with Damien because there's so much information. Just before I bring him in, let me just remind you that we're not providing specific financial or legal advice. This is a general conversation only. We moderate the chat, but feel free to throw your questions, comments, suggestions in as we go. This is as at the 4th of November 2025, and I've enabled Super Chat, so if you'd like to get your question to the top of the list, use @WalkTheWorld and Super Chat to do that. Or indeed, if you want to make Super Chat contributions, always greatly appreciated. We thank you for all of those who support us, whether it's via the Super Chat, whether it's via Patreon, or indeed via PayPal. All really helps to do what we do here. We don't do this for profit. We do this because there's a really important conversation to be had, especially now. Right, let me bring Damien straight in. Damien, welcome back. How are you doing?
Yeah, not too bad, Martin. Not too bad. Markets keep rising, so don't keep worrying about when it's going to fall.
Yeah. Well, it is an interesting question, isn't it? And I pose this, investing now, navigating peak uncertainty, because there is a lot of uncertainty out there at a time when markets are actually still very high. And in my,
I hope you're right, Martin. That it is peak. It's not going to. It's going to get more uncertain.
Yeah, well, it could well, and that is the question. Where are we? We've got closures in the US, which means the information flows are a little bit off compared with what we might normally get. We've got big AI investments running. We've got some liquidity wobbles in corners of the market, particularly in the US with reverse repos and things like that. In Australia, we had the RBA today, and we'll touch on the RBA conversation in just a second, because I think it's really important to understand what the RBA is thinking about. But before we get into that, I just wanted to say my conversations with a couple of, well, more than a couple actually, over the last couple of weeks, one-to-one conversations, is there's a sense of it's almost too uncertain to do anything. So I feel that some people are frozen into non-action. And I just wonder whether you were seeing that and whether you think that's actually a logical position, or are people missing opportunity because of it?
Yeah, it's tough. Look, I think there's times they say when markets sort of climb a wall of worry, and I feel as if that's where we've certainly been for the last year or so. And it's been this thought around, or certain maybe years too much. I think there was some positivity around the start of Trump, and then he started doing some quite sort of unfamiliar things, let's say, and then I think there was people have been surprised continually how the market keeps rising in the back of that, and I think we've sort of been of the view that look, there's an AI bubble going on in one part, and when I say a bubble, I think it's certainly there's a capex boom going on within that sector that's really driving one part of the US economy. And so you need to sort of say there's multiple things going on. Yes, there's a whole bunch of things going on in a whole bunch of sectors that might be quite negative, but actually there's how much of the positivity is coming out of that one sector, and then what's happening elsewhere in the world, and is what is happening going to be enough to throw it off kilter? And it might be, but by the same token, that it might not be. And it's this point about saying, well, if you keep investing for the worst case all the time, then you'll always be sitting in cash. And we're sort of trying to, I think we're certainly getting to quite high valuations at the moment at an aggregate level, but there's also a lot of stocks that are actually quite cheap at the moment relative to some of their history. And so it's a matter of saying, do I want to pay up for this high growth AI stocks, and how much do I want to pay for them, and then how much I'm willing to pay for just an ordinary stock that sort of doesn't have as good growth prospects. And I think if you sort of take a look back and go, well, I don't want to pay top dollar for markets that might be going to fall, is like, well, what happens if you avoid all the AI and you just bought all the other stocks? Would you be happy with that? or vice versa? Do you want to just go for the growth and buy some of the AI? And that's something we give people the opportunity to do within portfolios, just to sort of get in and modify, what we're doing, or what's available, so that you can sort of try and balance it out a little bit more.
Yeah, very good. As somebody was saying, hey, you're wobbling the camera.
I think it's me wobbling the table, actually, getting excited with my.
But
Yes.
no, it's interesting. And I think one point I'd make as we go into this, there's a difference between time in market and timing the market, right? And I've always believed that it's very hard to time the market. You can do a lot of analysis and you can try and work out where the opportunities lie. But at the end of the day, a lot of it is actually time in market, because over the medium to long term, we go off to the right.
Yeah, that's right. And there's sort of there's three things I sort of highlight with these, or three different ways you can try and play this. Some people, like ourselves, within our sort of tactical funds, basically have the view that, look, you've got your standard version, and what your standard sort of holdings in terms of what your risk allocation is. So let's say you're going to be 70% stocks and 30% cash and bonds. Is that the idea is we're going to lean into that. So when we think things are looking better, then what we'll do is we'll buy more stocks, and when things are looking worse, then we'll sell more. But it's about shifting it around that sort of central point. So that's one way of taking it. Another way is when the people say, look, markets go up and they go down. I'm just going to invest and keep investing over time, and just take the fact that sometimes it'll be good for me, sometimes it'll be bad for me, but over the long term, I'll actually make more money out of it. And that's sort of another class. I think that the main thing for those people, and I'm not saying so I'm quite encouraging of that if that's what the view you've taken. But if you've taken that view, you need to keep that view. So I've certainly had people come to me and say, yes, this is my view. I stick with the markets. I'm just going to, they go up, they go down. I'm just going to ride it. And then you get something like, the Trump and Liberation Day, and some of them then turn around and go, actually, I've changed my mind. The market's just fallen 20%. That's it. I'm out. I'm not going to do that anymore. I'm going to go and invest in some other asset class, and then I'll come back when markets are clearer. And then markets jump, another 35, 40%, whether they're up off the bottom, and you've missed that because you said you weren't trying to time the market, but then when push came to shove, you did try and time the market. And so I think there's that there's sort of two angles around that. And then the other one is the person who just says, yes, I'm going to time it. I'm going to jump in. I'm going to jump out. I'm going to go to 100% in. I'm going to be 100% out. And so that one, look, there's some people who think they can do it, and some people, I think there's a couple of things I'd like to highlight with that. Every time you make a decision to get out of the market, you need to make another decision getting into the market. So you need to get two things right. And secondly, the other thing is with it is there can be some big tax consequences for that. So, if your markets have risen 20% and you've sold out all your gains, that's great. They fall 10% and then they start rising, and then you decide to get back in again, and net effect is you've saved yourself whatever 6 or 7%. Well, maybe you've just spent that in tax anyway, because you've just realized a 20% capital gain and whatever you're going to pay on that 20% capital gain. And so there's that idea that if you're going to be constantly flipping in and out of markets, great for stockbrokers. They'll love you. There's lots of commissions that get paid. Great for the tax man. They love you as well. But that idea of that compounding returns can be, you can really miss out on some gains. And so, keeping an eye on that and just thinking, well, if I do think markets are going to be down by 10%, well, what's my tax bill going to be if I sell it? What versus, how much am I going to save, and what's that net trip? And if I get it exactly right, some of these is like, yes, if I sold it exactly at the top and bought it exactly at the bottom, sometimes you can even look and say the tax just wasn't worth it.
Yeah, and the point there is that if you do zig and zag on your strategy, you're going to end up essentially knocking the good returns that are potentially there out, and potentially not getting the timing right. So all of those things I think are important, and so you need to stick to your guns. And I remember in the 2007 drops, I was on the ABC a few times talking about some of those things and saying it amazes me that people are now bailing out when stocks have really dropped significantly. And actually, that's probably the very last time to bail out, because effectively you've lost all of that momentum that you'd created previously. It'll come back. And of course, markets did come back ultimately. But
Mm.
when you're in the midst of that sort of run for the exits, it's worth remembering, of course, that a lot of the professional investors trade liquidity, and a lot of them have already pre-positioned ahead. So effectively, they are the ones who are actually protected, whereas ordinary investors, they rely on those ordinary investors panicking and then selling at the wrong point.
Absolutely, absolutely, and we'll talk about that a little bit later when we talk about more about the AI boom, because that's what we're speaking a little bit. I think some of those ones for retail investors who are certainly still piling into the whole AI boom. At some point, I think there will be some good markers that'll come from when we're starting to really peak in that, and something for us to watch.
Okay. Well, let's just talk about the RBA briefly, because, of course, they had their announcement today. And not surprisingly, perhaps, they didn't move the cash rate. And they highlighted the fact that inflation had picked up recently. Headline inflation rose sharply, they said, to 3.2%. And the underlying inflation was due to temporary factors, they said. Well, yeah, interesting. Underlying inflation, though, is likely to rise above 3% in coming quarters before settling at 2.6% in 2027. It's like, Nirvana just around the corner always, right? It'll be okay. It'll okay. And this is the trimmed mean inflation targeting, and you can see there the peak up, right? So November 2025, we're suddenly seeing, oh, okay, a bit of a hump, but it's going to come back down. Now, that could be sheeted to the electricity and other bits and pieces. Although, actually, interestingly, also, they did adjust their unemployment rate forecast to 4.4 rather than 4.3%, which is still, I think, quite generous with regard to what could happen. And I just want to show you this. IFM did a quite interesting inflation stickiness model based on the Atlanta Fed, but for Australia. And they were highlighting that stickiness is, not too bad. So maybe it is temporary. So that was really the sort of the takeout. And I guess the sort of the observation here was that they went on to say things like, well, housing market is strengthening, and that may be a good thing. Wages growth is easing. Uncertainty in the global economy remains elevated, and they think that the monetary policy remains a little restrictive. The lags are still there. Uncertainties, and it's interesting how uncertainty again basically continues to wobble through all their conversations, hence my my title for this show. And they're basically saying that they maintain the cash level this time, and there is evidence of more persistent inflation, etc., and they'll be attentive to the data. So the prospect of deep rate cuts from this point, unless something goes really pear-shaped, is probably off the table. There's a prospect of maybe one more cut next year sometime. Maybe that's what's in their forecast. But nevertheless, there's also some hinting, I think, of almost, without wanting to mention stagflationary factors wobbling around. So that was my take. Any observation from your end?
Yeah, I think the first part I'd say overall is, and this is, I'll sort of go back before the inflation report, which sort of I think was a nail in the coffin for saying that there wasn't any rate coming. But even before that, it would seem to me that the RBA was looking for excuses not to cut. And so, whereas I think in the US, it seems like it's been the opposite. So it seems like we've got a Fed who's looking for an excuse to cut. And so you're sort of sitting at that relatively, you're sitting with some contrast, some significant contrast in there in terms of what's happened. And I think that's probably what's going to follow through. I would say over the next little while is that the RBA will be more reticent to cut. They sort of seem to be putting a lot more focus on the inflation rate and a lot less on the unemployment, whereas it seemed like the US was sort of facing not dissimilar numbers and sort of trying to talk themselves into a rate cut. With is the employment weakening enough that it's worthwhile doing this? Yeah, and looking through some of the effects of the tariffs and things like that. So yeah, so I think that would seem where we are. But I think there's going to be a bit of a shake-up at the Fed, obviously coming next year, and we'll see what happens with in terms of Australia. I think we're very much tied to what's happening in China, and I think the net effect of the negotiations or whatever you want to call it between them and Trump has probably been a lot more positive than I would have thought. In terms of they've come out a lot better so far.
Yeah, there was an interesting interview with Myron on Bloomberg the other day, and he was talking about, do you look at the stock market or do you look at the housing market? Because if you look at the housing market in the US, then things are actually a little bit more, weak relative to the markets. And it's a matter, I guess, of perspective as to where you look at, momentum or not. And the AI story, of course, is part of that. In Australia, of course, the housing is a big question. It's interesting that in the Statement of Monetary Policy, there was actually an observation here about the 5% deposit scheme, which is, quote, extended to put further upward pressure on housing prices in the period ahead. Price increases contribute to a 4.5% increase in real household wealth over the year to June, which is expected to support household consumption in the forecast. So I think it's probably true to say that the RBA is banking on house price growth to try and support the momentum and housing consumption, which is a bit of a wealth problem maybe there if you're not in the market, of course. And it's also, as Alex said here, the RBA is running with the idea that rising house prices are positive for economic growth. It doesn't discuss affordability for first-home buyers, nor higher household debt being a future drag on growth. So I thought that was quite an interesting observation. So they seem to be sort of picking the story, right, about house prices.
That's somebody else's problem.
Yeah, exactly right. Yeah, we're not responsible for that. Nothing to do with us. We just plug it in our model and see what happens, right? Because it creates more wealth, and that means that people can spend more. But I would highlight that in my own surveys and in other publicly available data in Australia, household consumption is still quite weak. Not uniformly spread across all segments, but quite a few. And, there are still stagflationary whiffs around this in Australia. And that's where we come back then to the other big angle, which, of course, is the China connection, the minerals and the resources sector story, and what's going to happen there. And I guess...
And energy prices.
Well, you took the words out of my mouth. And of course, the real killer in all of this is high energy prices, which continues to squeeze industry dramatically, despite the fact that now they're starting to say, well, we'll give a bit of money here and a bit of money there or whatever. Or indeed, you'll have 3 hours free energy for some people, which seems weird to me because you've still got the fixed cost. But anyway, that's another story.
Yes. Well, I think they're trying to. It seems like they're trying to say, well, we don't want to. Rather than charge negative energy for people who are doing it, let's try and give this away for free. But yeah, okay. So a couple of things to unpack there, but I think you're right in that. Look, Australia's got this issue around house prices, and we've got an issue around energy prices. And I'd say that our government has little interest in solving either of them, and arguably they just want to add a bit more fuel to the fire for the hopefully not for energy, but certainly for prices for housing. Obviously those 5% down is more fuel for that fire. And it's interesting as well. I don't want to play too much on it because it is only one city in the US, but the US mayor for New York is looking like being effectively is effectively running on a platform of I care about our rent prices. And so, whether his solutions are right, they're probably not, but at least the thing is he's being heard for what he's saying is, rents are too high in New York, we need to bring it down. And I think there's potential, that's our best hope in Australia because neither side of politics is particularly interested in it. And actually, and even the Greens and other parties, pay a little bit of lip service to, it'd be nice if, be great if things were more affordable without house prices having to fall. Maybe house prices could keep rising but get more affordable would be the perfect solution for all our politicians. But I don't think that's So anyway, I'm not expecting any movement on that side until we actually start to see sort of groundswell of political support behind that.
No, I think that's right. And nobody really wants to take the hard medicine in Australia. That's been the problem for quite some time. And, banking on the continued momentum from high migration, high house prices. But I actually, in my surveys, do see the real impact of the high energy prices percolating through to households and also small businesses too. It's very interesting that, everyone's talking about the aluminium producer or whatever, but actually a lot of small businesses, when I look at them in my surveys, are now saying it's actually the cost of energy, which is actually one of the critical drains on their profitability. and it's holding them back from investing and buying new machinery or investing in more people simply because
Yeah.
the costs of doing business are too high.
Yeah, and we've spoken. There's always a focus from governments on saying innovation. We're going to bring more manufacturing back to Australia and all these things like that. Look, if you've got high energy, some of the higher energy prices in the world, then you're not going to bring it. There's just um, it's so much easier to start up these businesses when you do have the lower energy prices. And so so I'm expecting that's going to continue to be a drain. There was something else on the energy side I was going to say. Energy prices. No, it'll come back to me. Let's keep going.
Yeah, cool. All right. Let me just bring a couple of other uncertainties to the table, right? And the one here, which is that the shutdown, the latest betting on it from Polymarket is it could be 61 days shutdown, which is doubling the record, right? And there are around 3,000 employees in the US in the air traffic control sector now short because they've dialed in sick because they're not being paid. You've got this one, which I thought was quite interesting. The global stock exchange market capitalization reached a new record high, again, 148 trillion. We've got this one here, which is effectively the price to book value is backed 5.3 times relative to 5.1 times in 2001 was .com. And you look at the earlier ones there. And you've got things like the margin debt, which is rising significantly and is a lot higher than it was even in 2021 or 2018 or 2007. So there are a few interesting observations there in terms of, is that a problem? And then, of course, you've got this one, which is the cap exchange, tech capex being absolutely going through the roof. And you can see it here being built. And it's tripled since the second quarter of 2023. Amazon, of course, is there and a few others too. And this old question about this relationship between all of these different players of different sizes, from the Oracles and Intels through to the Open AIs, money flowing all over the place. And is that a Ponzi? And of course, the old MIT survey, which was actually a quite limited survey, by the way, so don't take too much from this, but saying that 95% of companies who invested in AI are not seeing any return yet. So it is quite interesting when you start put this together. So there's a level of uncertainty and noise in all of this, which I find quite interesting. And so going back to this navigating uncertainty, how do you pull this apart, Damien? And how do you make good investment decisions with all this uncertainty out there?
Yeah, and so I think I could have spent 10 minutes on each of the graphs.
Well, feel free.
So I'm gonna let me start going through some of them and sort of bring back. So I think let's start with the valuation side. Actually, I might jump to so you had a chart up there about the price to book.
Yes.
Price to book and price to sales ones, I see quite often these ones popping up because they are very, very high relative to history. I'm not as convinced with these ones. So that price to book one in particular, book values, the way people account for book values changed quite dramatically about 25 years ago. And so the stuff you see before that is very different. So the big picture change is what used to happen is I'm in the 1960s. I've got a factory. We're going into a recession. All of a sudden, I just built the factory. I'm going to write it down, and I'll do a write down of my factory. And I'll say, okay, I built it for $10 million. Actually, we're into a recession. It's only worth $5 million now. And then 3 years later, we come roaring out of recession. My factory's at full capacity and everything like that. And I'm like, oh, you know what? I was wrong. I wrote it down, and I'm going to write it back up again, and I'll write it up to whatever, $8 million or whatever I think it's worth now. So that's where you used to do it. Now once you've written it down, very, very difficult to ever write something back up again. And so what it means is equity goes down and it never comes up. And so that price to book ratio, you're basically looking at a price on the top, which can go up, and this price on the bottom that only ever goes down. And the other thing was you didn't used to have buybacks. And so buybacks also affects your equity. And so I just don't think we're comparing apples with apples when we look at those ones. Price to sales is another one that's very commonly looked at. And we were certainly at record highs and when you look at price to sales ratios. The problem with price to sales is margins are also at record highs. And so it's this idea that, but the profits aren't when we do a price to profits, it's not as bad. The price to sales always looks bad because of two factors. One is there's been this switch from manufacturing to services, and so what that means is as you switch from that, generally margins improve. So when you've got to you've got to build some big factory and depreciate it and then make this money from it. Quite often those things are quite low margin, and so yes, you've had that effect, and then the second effect is companies have tended to outsource low margin stuff to China and or outsource to private industry. The idea that Warren Buffett came out saying, "Hey, high margins are good. It's quality companies have high margins," which is completely agree with, but it's been taken to heart, and companies have said, "Well, I want high margins." And so, one of the ones I use as an example is shipbuilding, which is one of Trump's trying to get shipbuilding back to the US. Is actually the shipbuilders make these really low margins. Who makes all the margins on building ships? Well, it's actually the engine manufacturers and the people doing the specialist components for it, propulsion systems and stuff like that. And so effectively what's happened is people who used to be shipbuilders have said, stuff this, I'm going to get rid of 50% of my sales and outsource it to China or outsource it to Korea or something like that, where they're happy to weld this stuff together at really low margins. And I'll make the high-tech stuff where you make really high margins. And so what that's done is that's sort of changed the economy as well. And so yeah, so I try to come back to cash flow or sales margins, and I'll pop up this chart of that I think is very telling about what's happening now. So just a bit of background, what I've done is I'm using the top 1,500 stocks by size, and what I've done is taken the biggest 2% of stocks, which is sort of about 35, 36% of the market is within that. Then I've taken the next from 2 to 20%, which is another sort of 36%. And then the middle 60%, and then finally the smallest 20%. And so the blue line we can see on this graph is the biggest, and they're expensive. They're certainly, and this top chart is the 12-month forward. The second chart's the 24-month forward. It's certainly at its peaks. But if you look through the rest of the market, it actually looks relatively reasonably priced. Like, it's not particularly different to how it's been any time over the last 25 years. And so when we're looking at the market, you need to be aware we're really looking at this two completely separate parts of the market. One is AI, which is expensive. And secondly, we're looking at expensive and high growth. And then we're looking at this other part of the market, which is just average price at average growth. And so the question really for investors is, how do you want to play this? Do you want to try and invest yourself in companies that are just not in AI at all? You can put together a portfolio that's valued at the same as a portfolio. It's not expensive. It's an average price. You can put together a portfolio without any AI, and that'll be your portfolio. Or you can look at the AI and say, well, actually, do I think it's going to grow? If I think AI is going to grow, say, 10% better than the rest of the market for a 10-year period, then it's probably cheap to buy it at today's values. You'll actually get value for what you're paying. But there's that dichotomy about how do you want to play this? What do you want exposure to, and what don't you want exposure to? And that's where sort of we're headed down the line of going, look, we are playing in the AI part, but we're sort of nervous about when it's going to finish, and we can talk a little bit more about that later. But there aren't sort of we're sort of, the bubble can get bigger, I guess is what I'm saying in that market. And so we're sort of, most of the stuff we're playing in is the high profitability ones, and a little bit at the sort of pointy end. And then what we're really doing with the rest of our portfolio is going through the stocks and going, okay, which are the sectors which we don't think are going to get hit as bad, and what can you buy them for? So, or which of the sectors have already been hit? So there's certainly sectors like, we're looking through a bunch of healthcare stocks which have had a relatively tough time of it. And they're sort of trading on single-digit PEs. You can buy those for 9 times earnings. And so, pretty much that a whole bunch of stocks within that sector. And so it's really, it's not a homogenous market. We're not looking at a market where just everything's expensive and nothing's cheap. It really is quite a diverse market that we're looking at.
Just one quick question on that chart. That's a global stock view, right?
Yes, that's the top 1,500 stocks, which is about 80% of the world market capitalization.
Right.
Yeah.
And
How does it look for Australia?
well, I was going to say, how does it look for Australia, and how does it look for the US? Because of course the US has an even more exalted
Oh,
proportion of AI, right?
yeah. Yeah, well, that biggest 2% is pretty much, if it's not all US, it's pretty close to all
Okay,
US.
right.
There, yeah, it's by far and away US. Yeah, you won't see too much different when you break it up for the US. Within Australia, you do. Australia's expensive. Yeah,
Yes.
is a short
Yes.
answer.
Yeah.
So
Because
yeah.
I was going to say, when I talk to people about the difference between Australia and other countries, particularly looking at property or looking at other investments, there are some quite significant differences.
Yes. Yeah. Australia is definitely expensive on all these measures. Um, yeah, there's stuff within Australia that's not, but I guess as well, it's worth noting that if you look through the top a lot of the top stocks in Australia, a lot of them are international stocks that just happen to be listed here.
Mm.
So CSL, Brambles, James Hardie, any of these stocks, they're just global stocks that happen to be listed here. Um, uh, BHP Rio, like the mining stocks are the same. Okay, now you get into the banks. Okay, now they're different. Like they are Australian stocks, and versus the rest of the world, they're roughly double. I think maybe not quite, but it's like 90% higher than the rest of the world in terms of the valuations on the Aussie banks. Um, and then you get into the JB Hi-Fi's and those types of companies that genuinely Australian companies listed here and leveraged to the Australian economy. And so yeah, sort of looking at those, they look a little bit expensive on those things.
So clearly, in that 2%, a lot of it's AI related. The Nvidias of
Yes.
this world and
Oh, the
what
Mag
have you. Yeah,
7
yeah, the Mag Seven, right?
yeah,
And
and then
so,
you sort of add in a few more like Broadcoms and stuff like that to
yeah.
give
I was
them.
going to
Yeah.
say, and what's happening at the moment is that more people are piling in to the AI story, like um, some of the old faithfuls, like Broadcom, or
Mm.
Oracle. Those people are sort of now getting on the act as well, trying to
Yep.
actually climb up the AI ladder. And as we discussed
Mm.
last time, of course, that's interesting because it suggests that there's a pool of activity around AI which is more than just the Max 7.
Yes. Yeah, let's talk about that interrelated chart you had as well. That was a good one. The
I'll
all
bring
these
it
things
back
going
up.
on. I feel like you need to update that every couple of days with
Yeah, I was going to
whatever the
say
new
this
one
is
is.
this is about 2 weeks out of date and it's already way old. But
Yeah. Well, let me talk I think the Oracle one's interesting in
yeah,
that um so Oracle's done a deal with OpenAI for $300 billion in cloud expenses,
yeah,
cost to run the service for them. Oracle hasn't built the servers yet. OpenAI looking like making $13 billion in sales this year and losing money. Um, so you've inked a deal with a company that's gonna needs to raise 300 billion to actually fulfill the deal. The flip side, so then Nvidia then goes and invests 100 billion in OpenAI. And so that's part of that. That's part of your 300 billion. But Oracle's then going to go and spend billions, probably tens of billions at least. Could be that whole 100 billion, who knows, on that cloud anyway. Like I mean, if you looked at roughly, yeah, what you put what how much you'd spend in Nvidia chips to build a data center, 300 billion. Yeah, would you spend a third of it? Probably close to a third of it on once you kept counting margins and all that type of stuff like that. Yeah, could easily go there. So effectively, it's almost vendor financing. Nvidia gives the money to OpenAI, OpenAI gives it to Oracle, and Oracle then goes and spends the money back. And so is that sustainable? Well, no, it's not. There's also within this, if my rough calculations is about two-thirds of all the calculations that are being done in terms of the AI calculations are actually by either people like OpenAI or Cognizant, not Cognizant, uh, complete mental blank on the other on some of the other ones. So all the people who actually have their models and are generating them, or it's being done by the Microsofts and Googles and Meta. So they're basically consuming their own resources, so to speak. So 2/3 of it's there. The other third of it's outside of that, which is probably quite genuine. Look, are companies struggling with it? Yeah, I bet they are. I bet companies are not making any money from it. But you would be an extremely brave CEO who said, no, this is never going to work. I'm not going to spend any money on it. Because if you took any of those sectors, um, I don't know, pick whatever it is. I'm a I'm a Coles or a Woolworths and saying, oh, look, I'm spending money on AI to try and recognize groceries so that I don't need as many people at the cash registers so that I can, scan the whatever it is. Yeah, I'm not saving any money because I still need all the people on the cash registers at the moment. I'm probably got a much bigger data cost now, and I need some people to do the calculations and all this stuff for me. I'm spending more money on it, and I'm not making a benefit from it. But if I'm the one who decides not to, and then all of a sudden my competitors comes good, and they've all of a sudden can cut their prices by 10% because they need fewer staff, that's where it could be a company changing event, and that's so from that perspective. Uh, yeah, I think it's going to be that part of the market. I think people are just going to spend the money, regardless of whether it's working or not. It's going to be very difficult for people not to spend the money for the next couple of years because the danger is you fall behind your competitors. So that's one part of it. The second part, though, is, and I think is the more important part at the moment, is you put up that graph of the companies with the four companies spending 100 and something billion dollars in capex. So that's sort of about 1% of US GDP that they're spending. So it's a significant amount, and almost all of that's going to be in the US. That's all coming from profits. These guys have got plenty of money coming in. And in a way, what's happening is, you know, Google is selling ads to you in Australia and people in Europe and all that type of stuff, taking the cash from that and going and building data centers in the US with it. Um, it's these guys are cash flow positive. They are making money on this at the moment, and so that's where the issue about when does the whole thing start, when does the whole thing come unraveled is like, well, I'm more concerned when we start seeing the debt financed ones, the ones like we saw in Oracle. That's the concerning ones where it's debt financed. The guys haven't got the money yet. If capital markets close and OpenAI can't raise the money, then that deal's dead. But if they stay open, then you know Oracle makes enough money from these deals to pay down their debt and to get themselves into a better position. And I look at Oracle as um, that Rorschach test. I think I spoke about it last time about what you think about the AI thing. It's either terrible that the whole thing's going to come unraveled, and if the AI boom stops in the next 6 months to probably maybe 18 months, they're going to be in trouble. If it goes longer than that, they'll have made enough money, they'll have paid their debt down. They actually could be one of the real winners in this because if you're buying data, and this is why OpenAI has effectively gone to them, OpenAI is looking and going, well, Microsoft's competing with me, Google's competing with me. When you look at Nvidia, they're like looking at the, I'm sorry, and AWS as well. When you look at Nvidia, they're like, well, Google's out there trying to create chips to compete with my chips. So's Amazon, so's Microsoft. There's Oracle's one of the few players in the industry who isn't trying to actively compete with all their customers. And so, if they can hold on long enough, or the boom lasts long enough that they get to pay down all that debt, then they could be a real winner out of this whole thing. And so, I think that's the point with this is you can look at things and say, yeah, this thing doesn't make sense, and it shouldn't. If everything went to normal right now, it's all going to end in tears. But if it keeps flowing for long enough, then that sort of, other things come out and money gets made and you can reach levels that you may not have expected. And that's the danger of saying, no, I'm going to sit this whole thing out. It's all going to end tomorrow. Well, if you're right, it's ending tomorrow. Yes, sit it out. But if you're like, oh, it's going to all end sometime in the next 5 years. Well, 5 years is a long time. Things can happen. Other things can change. And so that's where that's where staying invested can really help.
Just a couple of quick observations. Firstly, there's a bit of an interesting discussion now about depreciation life cycles of some of this tech, right? How quickly will those AI chips be replaced with ones that are much more valuable because they're more powerful, or even the infrastructure around data centers? It takes a bit of time to build them, and some people are drawing analogies between what's happening now with data centers and what happened at the .com boom bust a period when
Mm.
there was a lot of dark fiber being invested in by telcos. A number of telcos disappeared, but actually the dark fiber ultimately got got used. And the other angle here is people like Caterpillar, which you wouldn't necessarily think would actually be impacted positively by AI, but they actually said in their recent results they were having huge demand because they're actually involved in the construction of data centers, partly because, of course, they have all of the machinery to do it, but also they're more actively involved too. So it shows you once again that the waves from that AI investment are spilling out more broadly too.
Well, yeah, and 1% of GDP from just four
Yep.
companies making up. It's just crazy. I mean, and we saw this happen in Australia. We saw it with our whole boom when we had our mining. Back in the mining boom, all that money and all that capex that was thrown at it. Now, one of the benefits from the US in the US is, in a way, is because Trump's been doing all this stuff with tariffs and it's on and it's off again, and other parts of the economy are quite slow. That may actually end up being a good thing for the whole, we've got this boom going on in AI. Okay, they're not competing as much with power because there's less demand for power. They're not competing as much for construction equipment that might have otherwise been out, building houses and buildings and things like that. So I think there's this real, there's lots of nuance within this, and unintended consequences, and sometimes things that Trump is doing that's bad for the economy might actually end up being a good thing because it just makes way for the AI to boom to sort of continue at more reasonable prices without having to pay crazy prices for things. Oh, and I remember that reminded me what I forgot to talk about before, which is related to this in a way, is the energy side.
Yes.
Is that and because some of this is happening in Australia as well, and because it tends to want to happen in developed countries, even though the power prices might be high, because you can get to the staff who can do it and have the knowledge to do it. But the thing is, the rough costs around this is, let me just get the figures right, is I think you can buy these NVIDIA chips and then lease them out, and your costs end up being $3 or $4 per gigawatt hour. Sorry, no, per sort of GPU hour. And so that's sort of your cost, $3 or $4. Now you can sell these things at the moment for like $10 on long-term leases. So these guys are making great money on this. The power cost within this is like 7 cents. So power prices for an AI center who needs the power, problems getting it up and running. But once you've got it up and running, if power prices quadrupled, you go from 7 cents to 28 cents, it's a drop in the bucket.
Mm.
You're not going to notice it. And which is why they can squeeze out the consumers and they can squeeze out those other sectors that actually do care about power prices. If power prices quadruple in the rest of the sector, they care. But that puts that extra pressure on a lot of the energy side to actually get this up and running. And so, look, we've looked through that sector. We've actually sold out a number of the players we had in that. We've still got a number of service players, but we were just looking at them last week. You look through the companies that are involved in that power sector doing like the turbines and the sort of the real heavy machinery of making the power. And these are sort of slow, sleepy industrial companies that are now trading on 50 and 60 times earnings. That you just sort of go, you look at it and you're just like, yeah, I'd love it. It looks great. I love the whole theory behind it. It's definitely going to happen. But do I want to pay 60 times earnings for this? And that's 60 times, assuming that they get the next couple of years worth of growth. And so I think what we're seeing is very much that, that part of what you said about Caterpillar is absolutely right. There's this whole section of companies that are sort of tangentially evolved that their prices are sort of shooting up because they've got some involvement and they get and you get that growth. You get some sort of initial kicker of growth in these prices they can charge these data centers because they just don't care about the prices. They're making so much money. They're just like, I don't care if I have to pay 3 times as much for a Caterpillar tractor. If I can get it built tomorrow rather than next week, then it's worth it to me. And so, but for me, they're the companies you need to more be concerned about because they're the ones that are like, yeah, I'm selling my ordinary thing to plug into a power plant. I'm selling it at 3 times the cost because these guys really want it. But at some point in the future, all of a sudden, I go back to the normal cost because the demand goes away and I get this double or triple whammy where the demand falls and then I go back to normal pricing and then everyone's just built these new factories to build these things and so everyone's trying to flood the market and you can get some real drop-offs in some of those.
Yeah, and of course that's the halo effect, isn't it? That's why everybody in corporate world is saying, "Oh yes, we're doing AI. Yes, yes, yes. AI is absolutely critical to our business. Business strategy,
Yeah.
and we're investing a lot in it, and we're training people." It's all about trying to actually get on the back of the rally.
Yeah.
Amusing little thought here. I actually use a little bit of AI when I do some of my modeling, right? I've been doing that for quite some time. And I think, well, maybe I should start saying driven by AI rather than actually driven by modeling,
Yeah, well,
and
absolutely. And that
double the
was
price.
I spoke about this when we first, a couple of years ago, about saying how this is there's a boom going on now. Now that capex you're seeing for companies, for those four companies, that's real capex. If you sort of did a line of how much spending's happening in AI around the economy, it'll be some crazy number that you're just
Yep.
like, wow, how did they get that high? And they got that high because there's just a bunch of rebranding, as you said. All of a sudden, Martin's rebranded himself as an AI company. I've got a data analyst who does stuff for me. Now they're an AI specialist, or whatever it is. And so, yeah, there's certainly that. The other thing, actually, I've just got a chart on that capex side. It's worth
Yeah.
one I'd like to show up as well. So, because this is the other one. So this is looking at tech investment as a percentage of US GDP. And so the software there, and so you can see we're hitting this peak of sort of 4.5% ish that we sort of hit in that 2000. And that's another thing people have said is, oh, that we're back to the same level, therefore it's a bubble, it's all going to finish. Now, I've got a couple of issues with that. One is uh, there's an upward trend to this naturally. The one I use is saying, if I was a farmer in 2000 and I'm buying myself a new tractor, that's a mechanical spend. If I'm a farmer in 2025 and I'm buying myself, some drones and some software to work out where the moisture is so I can better target my plants, all of a sudden it's a tech spend. Like there's just a different that sort of that bar is naturally rising, I guess is what I'm saying. I think you can probably say a better thing that look from that 2000s to the peak there was that sudden jump of maybe 1.5% of GDP. And I think that's the part where it's like, okay, that's the concerning part. So, our natural trend was probably pretty close to 4%. So if you're at 5% or 5.5%, okay, now I'm getting starting to get a bit more worried. I think it's a bit of it's that, how much higher are you above that naturally rising trend line, which is we're just spending more on tech as time goes on. So that was one part. And then the other thing to keep in mind, just on the same graph as well, is, if you want to put that into perspective, the railroad boom, I know it's a long time ago, but they were sort of spending 6% of GDP at one point, and they a number of years above 4% GDP on that whole railroad boom. And I think that's, those analogies are, not dissimilar, and I think sort of worth keeping in mind for when we're trying to work out, are we there yet? Because the main issue we're talking about here is, okay, I can look at everything that's expensive and all that type of stuff, and there's this idea that there's a similar to the tech boom, and I don't deny any of that. But if you're looking at it and saying, okay, this bubble can get 50% bigger before it finally comes undone, then that's a lot more market return you're missing out on. And so, and you just don't know what might happen. It might get 30% bigger and then something else pops up that then means that actually the world economy doesn't go down before the next thing takes over and you've missed out on all that upside if you sit out the whole thing. So yes.
And I think there's an interesting analogy between the railway and railway mania. It's 250 years ago that the first passenger trains ran in the UK, right? And if you think about it, there were a lot of companies that went bust, particularly in the early period of time, but we've still got a significant infrastructure, maybe less than it was. And, railroads are still important and railway lines are pretty important. So there is always a kernel of value that's created and left as a legacy, just as the dot-com boom bust left us with a legacy of dark fiber that got lit later, and we're using it for the backbone of the internet now. But individual companies might go pop on the way through, and it's important to shift the focus between individual players who may or may not be around and the broader mega trend that still has very significant echoes later. And a bit like the internet, my belief is that the prospect of the value that will be created out of AI will be different from what people think it is today, but it will still be substantial, just as the internet is substantial now compared with where it was back in the mid 90s and the early 2000s. So having that long perspective also is quite important, I think, too.
Yeah, that's right. Now, what are some of the things you should watch to work out whether this is going to finish?
Yeah.
I've got a chart up just showing earnings. So this reporting season so far, so it's third quarter reporting season in the US. These are the blue lines basically show the earnings forecasts for the S&P over time. So as it sort of, you know, gradually moves along to what and ends up wherever it ends up. The red line is the 12-month forward number. So it's basically taking a little bit more of 2026 every sort of day that goes past and a little bit less of 2025. Now, when that line stops rising, that's when you need to get worried about markets. And we saw 2022 it fell, and we saw markets fall quite substantially over that period. We saw this wobble earlier on this year where the earnings expectations fell, and when we saw markets fall at the same time. But we're on this bit of a rocket ship at the moment. So yeah, look, maybe this will come unstuck at some point, but at the moment, those profits upgrades are still there. And the other thing I just want to highlight along this same lines, I'll jump to there's this concept. Yeah, broadly, if you think about markets, you can say economies. You can say there's a government sector, there's a household sector, there's a foreign sector about in terms of trading, and then you've got the corporates. And what I'm showing up on this screen is something from Hussman, who puts this one together, which I quite like, which is basically showing what's your corporate free cash flow in blue, and then what's the deficits of US government, households, and foreign trading partners in red. And there's a pretty good inverse correlation between it because the whole thing sort of fits together because it's, if the US government's out there spending more money, then that money is accruing to one of the other parts of the economy or it's flowing overseas. And usually corporates are really good at capturing that money. So when governments are out there spending lots, corporate profits tend to be high. And that's where we are at the moment. So if you think Doge is coming back and Elon in his chainsaw, then I'd be a lot more concerned about the whole thing. But if that's sort of if you think that they've put that behind them and deficits are just going to get larger, then corporate profits are probably going to stay pretty healthy until we see at least one of those economies, one of those parts of the economy start to pull back.
Yes, absolutely. And it is fascinating to just watch this play out. Jason actually floated a question earlier on about the Microsoft investment in Australia, right? Because Microsoft, I think, is going to invest something like 15 billion, I think, in a data center in Australia. Interesting in the context of power in Australia, right? Power in Australia, we pay some of the highest costs around the place. So I'm thinking, interesting. What happens if power prices go up there? But your point is dead right. They can afford it, right? Because it's a relatively small proportion. Right. So it's the rest of the economy and the rest of households that effectively get to pick up the bill.
Yes, yeah, that's right. And the other thing they're finding, particularly in the US now, there's a couple of particular sectors, a couple of particular regions. I think North Carolina. There's a couple of ones anyway where they've built enough of these data centers that they're really starting to influence local power prices. Are really starting to shoot up, and so that's definitely an issue in terms of social license.
Absolutely, and as Jason said, it's sad for ordinary consumers, and that's the point. We at the end of this, they end up with the dab end of the stick because we don't have the same margins as some of the AI companies. So, thinking about the story then in terms of the markets, you've got this idea of there are potentially other sectors of the market that are actually more interesting than the AI ones because they haven't gone up as far yet and they're bubbling along, like healthcare and those sorts of things. And there are things that people have to continue to buy whether they want to or whether they have to. Suggests that as well as thinking about the AI story, it's important to think beyond AI too.
Yeah, absolutely. I think there's, you need a diversified portfolio regardless, but I think it's well worth, right now, more than any time over the last 10 years, there's this massive divergence in what you can get. And so, the pricing is roughly I would say about, I'm just trying to think because it's gone up a little bit since I last calculated. I would say you're talking about if you think AI companies can do 10% per annum better than the rest of the market for the next 10 years, then you should be buying AI companies because it's still a fair price at that. If you think they're only going to do 5% better or it's going to finish in 5 years, now you're like, okay, now it's a bit dicier and maybe they're overpriced or whatever it is. Having said that, again, even within these, there's still quite big divergences. There's the question is, do you want to buy stocks that have basically got no earnings and it's all in the future, or do you want to buy the ones that are actually spitting off heaps of cash and still reinvesting that back in? And so there's still enough room to play, or do you want to go for something probably closer to the middle, something like an Oracle, which is sort of not losing money, but they're about to reinvest more than what they've got and really take a huge swing at the whole AI part.
Yeah,
And
very
so
interesting.
yeah.
That I just want to give another perspective because I think this is quite an interesting perspective too. And it's this chart here. This is actually looking at the S&P 500 bull and bear markets total returns from 1949 to 2025. And I guess the thing to highlight, we talked about ups and downs and things. Actually, if you look at that trend, you can see that the markets are spending much, much more time going up to the right than the relatively minor corrections that we've had during that period. I think that longer term perspective is actually really important for those who actually are thinking about investing in the markets.
Yes, yes, absolutely. And I'm just trying to see where we're sitting in that on that last one, down 19%. I suppose that was just before, that was June 2025. Right. Okay.
Yeah,
And then you've started the next
correct,
rise up from that. I was just
correct.
thinking, it didn't feel like 78%, but and it's probably 30 something percent, I think, already on that. The next, like,
Yeah,
if you
yeah.
extended that to today, I think it's
I,
just
I
30
think
something
it's
percent
slightly
at
out of
least.
date now, but my general point was just look at the mapping of bulls versus bears. That's a really interesting observation on markets, isn't it?
Yeah, yeah, absolutely. And that's what you're here to play for, I guess. I mean, big picture wise, um, earnings sort of grow over the long term at sort of 6-ish percent. Earnings per share grow at sort of 6-ish percent. Um, and so, and if you sort of look through that, part of that's going to be inflation. Part of that's share buybacks and things like that sort of give you a little bit more sort of juicing of that. And then so if that's what you can get, and so valuations don't change, you're getting that 6% plus whatever your yield is. And so the yield on the US, if you sort of count the buybacks and other cash they're putting back through, you're talking 2-3% at least. And so and you can sort of maybe 4% if depending upon how you want to calculate it. So that sort of gives you that, are you going to get somewhere 8 to 10% growth in the long term? Is that if valuations don't change? Now you're going to go through periods where earnings are going to grow a lot faster. You're going to go through earnings where earnings will grow slower. You go through periods where earnings will margins will valuation multiples will expand and contract, and that sort of gives you some of that. But that idea that I can buy this asset and get that sort of long-term return, that's what you're really looking for. But knowing that there's going to be some wild years in there. There's going to be years of minus 20%, and there's going to be years of plus 40. And so if you're willing to ride that out, you've got to make that bet and then ride it out and don't try and second guess yourself. Or if you want to go into something like a more tactical portfolio, you can really cut the edges off. So by putting in bonds and other assets within it. And then we do that bit where we lean in and out. But even if you didn't do the leaning in and out of cycles, if you just sort of put the bonds, now you'll sort of reduce the volatility by probably half at least. And then that sort of brings in all those curves. So rather than losing 20% or gaining 40%, now you're like, okay, I might lose 10% in a bad year, but a good year might be plus 25 rather than plus 40. And so it just sort of brings you back into those ranges that sort of give you more, more I guess palatable returns for people. But for some that's like, well, no, actually, I'll just take that. I'll ride out the volatility and just take the view that equity markets eventually will get there in the long term.
Yeah.
And especially, it's probably more important if you are going to be continuously investing. So, say it's your superannuation, or you've just you're putting money away constantly. Then you should be more likely to want an equity portfolio and be less concerned about the valuation you're buying at, because it's like, well, sometimes going to get it right, sometimes I'm going to get it wrong. as long as I'm continually investing. If you putting a big lump sum in, that's can be a lot harder on that point.
Yeah, and the point to make is time in market is important as that chart. But the other point is that as you move up towards particularly critical dates in your own life, I'm thinking maybe of
Mm.
retirement or those things, then it becomes more time critical. And therefore, it's really important to recognize that through life, the mix of investments that you make and the portfolio construction that is best changes.
Absolutely. Yes. The closer you get to retirement, the more you should be sort of winding back on equities and sort of getting more bonds or more stable assets within it. Depending upon your levels as well. Because I mean, the thing is, if you've got, if you're sitting there with $20 million, then cash flow should not be an issue for you. And so maybe you are willing to take some more some more leave the risk on the table, and you don't have to worry as much about that. Okay, if I have a 10% dip pull down or a 20% pull down, it's not going to cost me my retirement because I've still got the money for it. Whereas if you're sitting there going, um, once it starts to go backwards, I guess that's the point. So as you're adding money to the whole time, then you're getting that benefit over that longer period of time. But as you start pulling money out, now you need to be concerned. Yes, if I all of a sudden have a 20% year and I've got to start pulling money out, well, that's gone forever because I'm spending that money. So maybe I'm better off now having a lot more cash in bonds and so that that how much longer the money's going to last you.
And the point I want to make there, it's not a sort of set and forget thing, right? You've got to actually
Mm.
revisit the strategy and revisit the portfolio on the way through to optimize it
Mm.
as you go through. And that's the part that I think some people do miss in all of this. And if you're sort of sitting in a fund that is sort of just vaguely managed, maybe that is not necessarily taking adequate account of the life stage changes that actually come through.
Yes, yes, absolutely. Absolutely. And so, yeah, and look, we certainly offer those tools. You can jump on it jump on it every year and sort of put them in and check the timeframes, and we'll spit out what we think, or our models will tell what we think the right risk allocation should be.
Now, let's talk about risk allocation in another way, because, of course, volatility is something that people are concerned about. And I want to put up this particular chart. This is, hang on, what happened? Didn't work. Okay, forget that. I was going to put the gold price up, but it didn't seem to want to come up, right? So gold actually hit, 4400. It's just down to 4,000 now. What
I have a
is
gold price I can show you.
good.
If
Yeah,
you can share mine.
let's go there then and get the gold price up. There we go. So I thought gold was meant to be, a benign, safe, secure bedrock. It'll always be there. But what on earth is going on with gold?
Yeah, gold. There's a whole bunch of things all pointing in the same direction. I think that's probably the main thing I'd say is I have sort of seven different uh, drivers of the gold price for me, and some of them are starting to turn at the moment. But that for a little bit there, they're all pointing in the same direction. So we had, gold is in some senses a currency, and particularly it's sort of a bit of an anti-US dollar in terms of. So you're basically saying, well, if the US dollar's falling, the gold price is probably rising with that. If I think about gold, if I think about gold as being just another alternative currency you can buy. It's a inflation hedge, maybe, and how I'll use that maybe is so if you look at this chart that we've got up there, it was a fantastic inflation hedge in the 70s where we had lots of sort of surprise inflation come through. Gold was great return for you. But if you look there from 1980 onwards, from the 80s, we had pretty high inflation throughout most of the 80s and a reasonable part of the 90s. And gold did not do a lot at all to protect you in that period, and you probably lost a lot of money depending upon when you bought it. And so, but it's certainly got a reputation as an inflationary hedge. And so the idea when you see surprise inflation and stagflation is people will be buying gold. There's a safety trade around it, and the whole idea of geopolitics. When geopolitics gets a bit weird, then you're buying gold for safety purposes. And Trump is throwing a lot of things at the world systems, and there's a lot of change going on, and so yeah, that's sort of moving in that positive direction as well. You can use it as another reason people buy it is, as an insurance hedge on societal breakdown, in terms of saying whatever, technology gets knocked out by by something from space, or we have natural disasters or whatever it is, and something, there's terrorism, there's wars, that gold is something that will be, in times of extreme trouble, that you can use it as an insurance hedge. Now, I mean, there's obviously a lot going on with Trump. I don't think I'd blame too much around that, but I will say that, social media in particular is creating a lot more echo chambers, and so if you do want to have a doomsday view, that there's probably an echo chamber for you. And so I'd say that, that's probably creating enough demand, certainly at the margin for it. There's the idea that, it's gold is, and it's a greater full investment. If I'm buying it not because it gives me any cash flow on its own, but because I can sell it to somebody else. And so from that perspective, if there's other investors out there that might want to buy it, and so it's sort of a bit self-fulfilling in when it's going up. You're trying to get in front of other investors. There's similar with central banks, and actually I do want to show a chart on that one. Actually, no, I might have overshot it. Sorry. Oh, that's the one I want. So we've actually sort of hit this stage where, the holdings of foreign countries in gold is now exceeding, US Treasuries again for the first time in sort of 25 years or something like that. Now, I think part of that's the Ukraine war, and we saw, diversification by Russia and China and other ones after they saw Russian assets get seized. But I think you've seen a renewed batch of that again, given the way Trump's treating, former allies like Canada or Brazil or people like that, where there's punitive tariffs and all these things going on. I think that there's a lot of countries sort of second guessing and thinking, well, I don't think Trump's going to take my US Treasuries, but maybe he will. Maybe he'll decide that, I've thrown one of his friends in jail, or I've done something that he didn't like, and so next step from tariff is taking my reserves. So, there's a little bit of that, I think, where central banks are sort of front running it. Um, and then finally, will he add some real gold nutters onto the Fed? Look, I don't think so. But last time around he was talking about it, and so maybe there's this idea that, you'll be adding people to the Fed, and the Fed will all of a sudden be out there buying gold, or trying to peg the dollar to it, or doing something else that you might think. Now, the interesting thing with gold, though, is regardless of which one of those you sort of want to subscribe to, none of them are in any way related to the price. They're just sort of they're untethered, and so the idea is that, uh, you know if you're buying gold because you think that central banks are going to be buying gold, then that argument works at $3,000, it works at $6,000, it works at $9,000. If you're buying it because, you think there's a safety trade and geopolitics is going to get worse, there's no price calculation in that. And so it's that constant thing with gold is always like, well, how do you actually bring it back to a price that matters? And I've done a podcast and a few posts on it recently, but I think some of the main things is just making sure, look, it shouldn't be your entire portfolio. It should be a hedge on your portfolio, not your entire portfolio. It's scaling your holdings in it. If you bought it at $2,000 and you've doubled your money on it, well, you should be taking money off the table. You shouldn't be trying to add more. You shouldn't be using that as an example to then say, oh, great, now I've got to throw even more of my assets at it. It's something you should be trying to use use as a part of your portfolio. So that was one thing with gold. The other thing then is to note that if you're looking for a direct exposure to the gold price, then you do probably want, and the movement it's doing. Then you want to go out and get gold, or hedge it to Aussie dollars. That your call in terms of what you're doing there. The thing is, if you're saying, if you're looking at this and going, no, I think it's a regime change. I think gold's going to hit this new price of, $4,000 to $4,500, and that's where it's going to trade for the next few years. Then at the moment, you're probably better off jumping into some of the gold stocks, because the gold stocks tend not to reflect the current gold price. They'll underperform when gold price really shoots up, and and same on the way down. They won't go as quickly. They probably price in, look, it's probably about 12 to 18 month sort of rolling average of whatever the prior gold price was, is sort of what I think you see priced into gold stocks. And so if gold is sort of hitting this new level, then gold stocks will continue to rise as sort of gold forecasts sort of get ratcheted up. If you're going to buy gold stocks, there's sort of four different categories you can do of them. There's the real major stocks, and most of these you can get through, through our sort of tilts. You can sort of grab for the major stocks. So they're like your massive, um, your Barrick Gold and these types of things that have got operations in many countries. They've got lots of big gold mines. You're getting exposure to the gold price, and you're really not. It's really not any one individual asset that's gonna sort of affect it. Then the next level down is the sort of mid-tier gold miners. Now those guys are going to be they'll tend to have one big asset and a couple of other smaller ones around. You might not get much country diversification. They're quite likely to get taken over. That's usually the next step, is the big guys start jumping in and buying out the mid-tier ones. Then you've got your sort of small cap gold that probably only have one meaningful operation, and you're really taking this operating risk. So if you do want to try and buy some of the small cap guys, buy a bunch of them, or at least do some really deep research into the ones you're buying, because problems at one operation can just blow you up. And then finally, you have the gold explorers, which are the guys that just don't even they don't have an operating mine. They're out there trying to prove up resources and trying to find something. And the same thing, even more risk within that. You either need really deep research to know what you're getting, or if you're trying to play the gold price by buying those ones, you need to buy a whole broad spread of them, and just recognize that there's lots of other things going on within those, geopolitical risks and all these other factors that can blow up, let alone the actual gold price.
Yeah, and it's very important to understand there's a difference between holding physical gold, and of course there's a cost involved in holding physical gold, versus holding the ETFs, which
Yes.
may have a charge attached to them and other things like that, versus investing in the gold miners, as you say, versus the gold explorers. There is quite a big pantheon of different options out there, and they have quite different characteristics. And sometimes when I read reports, people have got this all scrambled up together. So I think that's the first point. Second interesting point, and it was actually one that Andrew raised, was, is the US likely to revalue the gold price? Now that's interesting because they have vast amounts of gold sitting at a very, very low value at the moment on the country's balance sheet, as it were. So if they did actually decide to reevaluate it, that would actually change some of the dynamics quite significantly as well.
Yeah, yeah, yeah. Is that something, Trump could write up the value and talk about how many billions of dollars he's just made for the country by changing the value of the gold price? Yeah, might be market.
Exactly.
And the other interesting thing from a supply point of view is, if you look at most metals out there, there's one of they fall into sort of these two camps. You're a primary metal like an iron ore or copper or something like that, and the biggest couple of mines does like 20, 30, 40% of the world production gets done by just a handful of mines. And then you sort of go out to sort of the top 50 mines are probably doing 80 or 90% of the entire world production all gets done. You sort of get these big low cost operations that sort of drive it. Or you're like a secondary or tertiary metal on something. So, you might be it might be something like a antimony or something like that, where it's like you're getting produced because somebody's producing something else. Somebody's already digging up copper and you happen to be part of that, or somebody's digging up gold and you happen to be part of that. And so it gets produced not because people really want to produce it, but they're like, well, I was digging for the gold. I also found this other thing, and so I may as well, it's worth something. I may as well get that out as well. And so those ones are a bit priced. Gold itself tends to be the very few large operations. They all tend to be quite small operations, and just so much more diversified than what you see in other areas. You don't get these mega projects, and you'd get quite small but high grade mines pop up from here to here, from here to there, and there's lots of kind of different countries involved. So if you looked at Australia and went, could you see some real benefits in Australia from this gold mine in terms of the boom going on? In some ways, yeah, you can see some more royalty revenue, but capex in Australia is like 5 billion at the moment. It's not gonna. You could double or triple it, and it's really not going to make that much of a difference to the overall economy. So it's not the same as your sort of mining booms where or the gas boom where one project was doing $50 billion in capex in WA. This is not quite the same magnitude that we're talking about.
Absolutely. And as we go into the sort of the last minutes of the show, I just wanted to come back to this other question which I had about the liquidity situation. This slide here. Oops, let me get that one coming in there.
That's
there
me.
you go.
Yes.
I've got too many buttons here. So this one was the overnight repo. Was a big blip up there. The reverse repos also moved up, and the Federal Reserve announced that they were actually reducing their runoff, and actually they've now come to ample reserves. So that there is a sort of a question under the hood here: is the financial plumbing in good fettle or not? And a few people are saying, well, there's a few, early warning signs potentially here. Treasury issuance seems reasonable at the moment. Treasury yields have dropped compared with where they were in many areas. But is that an important take, or is this a sort of a minority sport at the moment? What do you think?
It's worth watching. I don't think it's. I think the net effect is these types of things to me happen when these happened 10, 20 years ago. The central banks were reticent to try and do things quickly, and they tended to sort of sit on their hands or pontificate about what might be causing it and whether it needed fixing and other things like that. My take is certainly over the last decade, the central banks have basically taken the view that, look, if there's problems in the plumbing, we'll just turn on the fire hose on full blast, and that'll blast out whatever blockages are there, and we're off and running again. So I do think there's you can be concerned about this if they continue. I do think there's some government shutdown stuff that's probably causing liquidity stuff as well. So I wouldn't be surprised if we do see different things going on. Then we've got regime change in terms of inflation and quantitative easing rolling off and things being added in other countries. So I fully expect that we will see these issues, but I also do expect that we're going to see central banks rushing to fix it before it gets anywhere dangerous. And so if I'm wrong on that, then markets will tumble. So certainly you should be aware it could happen. But I think the central banking has changed dramatically over the last decade or so, and they look upon this now, rightly or wrongly, as if there's a problem, we throw cash at it until it's not a problem anymore, and then we worry about it afterwards.
Yeah, and it's worth saying that the repo market in the US is now quite different from where it used to be. It's almost a sort of a permanent facility that people can draw on if needed, and it's like, it's just part of the plumbing, So they've almost got. You could think of it as a sort of an escape valve when there is pressure. So effectively, it's almost set up now to be part of the permanent structure within the financial system. And as you say, central banks, they're all over this.
Yeah, and just to put it into perspective as well, the US just gave Argentina of all countries $40 billion to get one of his mates elected. To help their financial plumbing. They're certainly more than willing to, if that's what Trump's willing to do for another country, then if there's any problems at all in the US, I'm sure he's willing to do whatever it takes to turn that fire hose firmly onto his market.
Yeah, absolutely. And of course, the deficits in the US continue to rise. The deficits in Australia continue to rise. It seems to be a permanent part of the story, and that's why I come right back to this idea of, well, valuations are continuing to rise, the debt's continuing to rise. These two things seem to be rising somewhat in the same direction, maybe because they're yin and yang of the same story.
Yeah, that's right. And exactly that part we were talking about earlier is that it is the yin and the yang. And when governments are running deficits, companies tend to be making more money. The money's got to go somewhere. It's either going to households or it's going to corporates. And particularly in the US, it's not going to households, much more likely to be going to corporates.
Absolutely. So as we come to the end of the show, Damien, final thoughts from you in terms of those people, thinking about the portfolio question. What are the questions that they may be wanting to think about for themselves as they come towards the end of this year?
Yeah, I'd be thinking about your portfolio as how much do I want to put into an average price market, which is what you can get sort of ex the AI, and then how much do I want to put into AI in terms and how much am I willing to pay for that extra growth that you're getting within it. And I think if you think about your portfolio that way, it's a much more accurate reflection of what we're facing at the moment. And I think you might find it easier to get a larger equity exposure than what you might have done otherwise. I think if you are concerned about markets falling and you think it's all about to unravel, imminently, then sure, stick with cash. But over the longer term, you should be really thinking about how you want to be. Are you playing the game to be completely in or completely out, or are you playing the game to be sitting there the whole time, or leaning into these cycles? And I think you need to choose which game you want to play, and then stick with that because otherwise, you big capital gains, big capital losses, and paying tax that you might not need to pay, and also just that whole risk of around timing.
Absolutely. And Jason, appreciate the super chat. Thank you very much. As always, greatly appreciated. And I guess, Damien, my perspective, as I said earlier on, is that, with any sort of investment strategies, it's not something that you can set and forget. It does need a little bit of, review and querying and just making sure that you've actually got the right thinking in place. And to highlight again, there are critical points through one's life where potentially you may need to change direction and just think about that too. So those are important factors, and that's why it's really important not just to say, oh well, I'm paying my super to a big fund up the road and I never hear from them, but I assume it's all right, is probably a bit of a concern because it may not be right, and so it's important. It really is important to do a little bit of cross-checking and thinking about it. And of course, the tools that you guys have are pretty amazing in terms of some of the different analytics and also the different options that are available.
And we didn't get to talking about the unlisted assets because that's where some of the danger. Where can I see some danger signs? Is private credit, is some of the unlisted assets. Maybe that's something we can talk about next time. But the a lot of the super funds do tend to have a lot of those within them, and so whereas we're much keener just to have fully transparent listed assets, you know what you've got, and you're not they're not valued. We're not marking our own homework to tell you, hey, we've got an airport that's worth whatever. It's like no, we're buying stuff that's listed. You can see the prices of it, and use those tools. Use the transparency to decide that if you've got other investments elsewhere, or you work for a particular company, you work for Woolworths and maybe you get shares from them, and you're like, I don't want any more shares in that, so run me my portfolio, but exclude that from my portfolio, or give me, I want more exposure. I've got plenty of exposure to Australian housing. Get me lots of exposure to international markets or something like that. So yeah, all very, very available, easy to customize, and fully transparent.
Yeah, and just to say that this whole question of the cockroaches in the system, to quote Jamie Dimon, right? I believe that a lot of those cockroaches are in those private asset classes, and unfortunately, some of the superannuation funds have significant exposures to those and don't necessarily revalue them that often. So as a result of that, there are some interesting questions and the unknown unknowns.
Yeah. Yeah, well, when the proverbial does finally hit the fan, I think that'll be a key area of danger is private equity and private credit. So yeah,
absolutely. So,
but we'll bring that up earlier next time. I know we
yeah. Well, let's add it to the agenda next time. And Damien, you will be back over the next month or two through Christmas and the summer. So I'll look forward to that. But I want to say thank you very much for coming on this evening and sharing your thoughts. As always, really appreciate it. Always really insightful. And we've put links and things below if people want to find out more about the services that are available. And feel free to follow on with that. So Damien, thank you so much.
And there's an AI report actually, I think, in that link. Hopefully, still is there? Yes.
We'll make sure that's there.
You can jump on there and download that. Yeah, excellent.
Thank you very much. I'll take you offline and close the show. Thank you, Damien. So there you go. Hope you enjoyed that. I think some really interesting points made tonight. The dogs are still, bits of dog are here. I've got one and a bit dogs. So Meteor's there, but sort of out of shot. There you go. Well, you're a bit more of... But anyway, she's still here. You might have heard the squeaks earlier on. Next week, it'll be me. I'll be coming back and talking about my latest analysis. I've been doing quite a lot of deep dives on some of the survey results, and we'll look at that. So check out that live show next Tuesday. And of course, I make my daily recorded shows, and there are quite a few recent ones that I think are quite significantly important, including the one relating to the cash situation in Australia and the need to get Treasury to change their strategy with regards to the so-called availability of cash. So check that out too. Thank you very much for spending some time with us this evening. Hope you had a good experience tonight, and appreciate all the questions, comments, and suggestions. We'll look forward to catching you next time. This is Martin North from Digital Finance Analytics, signing off. Take care.